Good morning, this is TOI Japan Market Radio for Tuesday, January 21, 2026. I'm your host here in Tokyo, bringing you the daily briefing on Japanese markets for global investors tracking Japan exposure. Let's dive straight into today's session.
Thanks for having me. Today we saw broad-based weakness across Japanese equities. The Nikkei 225 closed at 52,774.641, down 0.408%, while the TOPIX fell more sharply by 0.92% to 3769.0. The Mothers Index, which tracks smaller growth names, dropped 3.328% to 2237.0, and the J-REIT Index declined 1.791% to 2028.5. On the currency side, dollar-yen traded at 157.825, down 0.223%. We're seeing some defensive rotation, with gold and yen terms up 3.431% to 18,390.0, while crude oil was essentially flat at 60.41, up just 0.116%.
So a clear risk-off tone in domestic equities, particularly in the growth and property sectors. Let's turn to the first major theme today, which is the action in Japanese government bonds. We saw JGBs rebound during the session after an earlier drop, and this is happening while the Nikkei has now fallen for 5 consecutive trading sessions. What's driving this divergence?
This is a classic flight to safety dynamic. When you see sustained equity weakness paired with bond strength, it tells you investors are rotating out of risk assets into the perceived safety of Japanese sovereign debt. The 5-day losing streak in equities signals that this isn't just a one-day correction, it's sustained pressure on domestic risk appetite. The fact that JGBs are rallying means yields are falling, which typically happens when investors are concerned about growth or external risk factors.
And for global investors watching Japanese equities, what does this sustained sell-off mean for positioning?
The extended losses are starting to test key support levels, and we need to watch whether this represents a temporary correction or the beginning of a broader risk-off cycle. For the Nikkei and TOPIX specifically, the bearish momentum is concerning because it suggests deteriorating sentiment around earnings sustainability. If this continues, we could see more pressure on cyclical sectors and export-oriented names. On the JGB side, falling yields compress carried trade profitability, which affects financial sector valuations.
Staying with the bond theme, there's also a broader story developing around U.S. market dynamics. We're seeing U.S. stock index futures advancing overnight, which creates an interesting backdrop for Japanese assets. How do you read this combination of strength in U.S. futures alongside the JGB rebound?
It's a mixed signal environment. The strength in U.S. futures suggests global risk appetite remains reasonably supported, which would typically provide tailwinds for Japanese equities given the heavy weighting toward exporters in our benchmark indices. However, the JGB rally indicates that domestic investors are still seeking safety. For the yen, we're seeing competing dynamics. The JGB rebound could support the yen if it's driven by safe haven demand, but strength in U.S. futures might limit yen appreciation by keeping risk on sentiment alive globally.
So near-term upside for Japanese equities could be capped even with positive U.S. momentum?
Exactly. If the JGB rally is signaling growth concerns domestically, that caps the upside potential for equities even when external conditions look supportive. We need to watch refinancing pressures as well. A sustained bond rally would push 10-year JGB yields lower, which eases refinancing costs but also signals market expectations of either slower Japanese growth or continued Bank of Japan accommodation. That's not necessarily bullish for equity valuations.
On the policy side, there's an important piece of analysis that came out today regarding Japan's Prime Minister and what's being described as a self-made fiscal trap. Can you walk us through what this means for investors?
This is a critical longer-term issue. The analysis suggests that recent policy commitments or fiscal positioning by the Prime Minister have created constraints that limit the government's flexibility going forward. Japan already faces the world's highest debt-to-GDP ratio at around 260%, combined with aging demographics that weigh on tax revenues. If the PM has rhetorically or institutionally locked in fiscal constraints, it reduces the government's ability to respond to economic shocks, fund growth initiatives, or manage debt sustainability.
And presumably this becomes more problematic if we see deflationary pressures return or if stimulus becomes necessary?
Absolutely. The fiscal trap is concerning because it removes policy tools at exactly the moment they might be needed most. For international investors, this raises questions about Japan's long-term fiscal trajectory and whether the government can credibly manage its debt obligations without either monetization or significant structural reforms. Neither of those outcomes is particularly attractive for asset prices.
Let's talk about the market impact then. How should global investors position around this fiscal constraint theme?
For equities, this creates medium-term negative pressure. If fiscal constraints prevent counter-cyclical policy or limit infrastructure and growth spending, that weighs particularly on cyclical stocks. Defensive sectors become relatively more attractive in that environment. On JGB yields, we could see upward pressure if the market starts pricing in reduced policy flexibility and elevated refinancing risks, although the Bank of Japan's yield curve control may cushion some of those moves. There's a risk of curve steepening if the long end reprices.
And the yen implications?
Fiscal deterioration typically pressures a currency, but the effects may be muted if BOJ policy divergence with global rates is the dominant factor. What we need to monitor is whether fiscal concerns start to trigger safe haven flows or whether investors begin to question Japan's fiscal credibility. Those would have very different FX outcomes. The key watch points are coming budget announcements, any stimulus measures, and of course the BOJ's policy stance in their upcoming meetings.
Shifting back to the near-term market action, it sounds like we're in a period where defensive positioning is being rewarded. The gold move today, up 3.431% in yen terms, certainly supports that view.
Yes, and that's a significant one-day move for gold. In a yen context, that kind of appreciation tells you investors are willing to pay up for safety and store of value assets. Combined with the JGB strength and the equity weakness, you're seeing a clear pattern of risk reduction in portfolios. The fact that crude oil was essentially flat suggests this isn't about broad commodity reflation, it's specifically about defensive assets.
For global investors who have Japan exposure, what are the key signposts to watch over the coming sessions to determine whether this is a temporary correction or something more sustained?
First, watch the Nikkei's technical levels. If we break below key support convincingly, that could trigger more systematic selling. Second, monitor JGB yield behavior, particularly whether the 10-year stays bid or if we see a reversal. Third, keep an eye on U.S. market follow-through because Japanese equities are highly correlated with global risk sentiment. And finally, any commentary from the Bank of Japan or government officials around policy flexibility will be critical given the fiscal trap concerns we discussed.
The other factor I want to touch on is the yen level itself. At 157.825, we're still in territory that would historically be considered quite weak for the yen. How does that play into the broader investment case for Japanese assets?
The yen level remains supportive for exporters in theory, but we're seeing that offset by concerns about growth and policy constraints. A weak yen traditionally boosts Nikkei earnings through translation effects, but if domestic demand is weak and fiscal policy is constrained, those benefits don't flow through as cleanly. For foreign investors, a yen at these levels means translation risk remains elevated, so currency hedging decisions become more important. If the yen strengthens from here on safe haven flows, unhedged equity positions would face headwinds from both equity weakness and currency appreciation.
Let's bring this together for our listeners. We've covered the equity weakness, the bond rally, and the fiscal policy constraints. What's the through line here for someone managing Japan exposure?
The through line is policy uncertainty combined with defensive positioning. Markets are signaling concern about Japan's growth trajectory and the government's ability to respond with fiscal tools, while simultaneously the global backdrop remains mixed with U.S. strength but domestic weakness. For portfolio managers, this argues for being selective in Japanese equities, favoring quality and defensive characteristics over cyclical exposure. On duration, JGBs are showing strength, but the fiscal concerns suggest being cautious about long-duration exposure if the market starts to question debt sustainability. And on currency, the yen's direction will depend on whether safe haven flows or policy divergence dominates, so active hedging makes sense.
That's a comprehensive framework. Before we close, any final thoughts on what global investors should prioritize as they assess their Japan allocations?
The key is to separate the near-term tactical picture from the longer-term structural issues. Near-term, we're in a defensive environment with sustained equity weakness and bond strength. Longer-term, the fiscal trap and policy constraints are structural headwinds that won't be resolved quickly. Investors need to decide whether current valuations after this 5-day sell-off compensate for those risks. Watch the policy response closely, because if the government can demonstrate fiscal credibility while maintaining growth support, that changes the calculus significantly.